Let's take a look at our put position. We're way down here. We're at 122, 124. We've got, oh, let's see, we've got maybe, if we had to, we're short these, so we'd have to buy these back at 19. Oops, I'm sorry, I'm over here. We're at 22, and we'd have to sell those out at 14. That's only 7 cents. You know what? It kind of makes sense to kind of roll those up as well. Maybe you can get some more credit by rolling them up maybe to the 130s and get another 20-30 cent credit on that. That would also help the profitability of our position. If we got the if we got up to around 130, that would be nice. So let's see. We got the put spread on at about 30-cent credit. So let's analyze this. We'll create a closing order for these, and we can actually take them off for maybe around 7-8 cents here. And let's see, so we made about 20 cents on that, and then we can roll these up. Let's go up to the 132s here and see what we can do. We'll sell a vertical there. Let me just change this for a second here. And we'll sell this vertical. Let's see what this does to our position. We're only going to get a 14-cent credit on that. Oh, okay, let me move my put down a little bit. And get another 26 cents credit. It's not too bad if we can make another 20 cents on that. Let's take a look at this duplicate trade. So we're going to be taking these off. And we're going to be adding this other position. And then what does that do? Well, we'll take a look at our picture. I mean, if the picture looks good, remember the picture. If the picture looks good, then we're going to be in a profitable position here. Right now, if we take off that 20 cents, we're going to make about $100 profit. If we put on another position, you can see that we're going to be, we're not going to have that $100 profit anymore, because we've got about $100 profit now, $86. But it puts us in a position to earn another $80 in credit. So all we have to do is we'll roll that up to the 132, 130 vertical short spread, and that just brings up our break even on the downside. Before it was, let's take a quick look at that. Before it was way down there. We're way down. We're down around break even is around 123 down here. And if we put this position on and we take off the one that we have for a profit there, then it moves up our break even to about 131, which is fine. But let's take a quick look at the chart. 131 on the SPY. Is going to be way down here. So, you know, unless, and we're way up here. So unless we're in a real bear market here and all of a sudden prices just totally collapse on us, which could happen, you know, and then we'll make a profit on the roll that we just made on the upside, and we'll roll down the and if we hit the break even down at the bottom side, we'll do the same thing that we did we just did on the call side. You know, we were hitting up against that other level break even up on the upside, and we just rolled it up for another credit. We could do the same thing on the downside, and we take a little profit at the same time. Now, commissions are always an issue. That's why I wouldn't sell this for less than 8 cents, because we did put it on for 28 cents. So we got 20 cents in there. That's about $100 profit on 5 positions, and we're rolling it up for another 27 cents. So, you know, or maybe 26 cents if we hit the mid price. So, you know, let's and then we take another 20 cents. We can make another $100 off of that. But we can do that. It's about $15 in commission. So we do give up a little profit, but we're in a profitable position. So, you know, it's not, we're not talking about being in a position where, that we're not making money. We are making money. We're taking in credits. We're actually selling positions back in a profitable position. So, it's not a bad position to be in. And we got filled right away on those. That's one thing I like about the SPYs is that, boy, you get filled very, very quickly on those. So let's take a look at our position now. We're going to delete our simulateds. And now we're back into a position where, we're right about in the middle again. We're right at 138.53. We're pretty good. We've got our break-even's 144 on the upside, which was a resistance level. Break-even is 131 down at the downside. And, we're back in the middle. We're not hurting on either way. And we rolled it out for a credit on the upside. We took our profits on the downside and moved up for another 20-cent credit if we don't hit that downside, and so we're in pretty good shape. And that's how you adjust your iron condors, at least. When you hit those break evens, just roll those credits up as long as you can do it, so that you don't get you don't get killed on those. Because if you let's say you sell those for 40 cents originally, and you can roll it up for another, and you've lost maybe 40 cents on that, and you can roll it up for another 40 cents, it's a break-even position. And you've extended your break-even on the entire position even more. So, why not do it? It's a good opportunity. And you can still, and it has not hurt our profitability on the overall position at all. If you take a look down here at our green expiration profitability graph, we're still at $370, which is very close to what we initially put the position on for. So we're kind of hoping to get at least 50% on that, or about $180 going towards the the close over the next couple of weeks. So that's how you manage your trades. You adjust as necessary. You don't have to get hurt. You don't have to take losses. You can, as you can see, we did not take a loss. In fact, we took a little bit of profit out of the position, and it was right up against our break even on the upside. We rolled out for an additional credit. We took our profits on the low side and rolled up for even more credit. So that's how you adjust these positions. You do not have to get hurt in the market if you know what to do. So go out there and trade with confidence.